Hey there, welcome back to the show. So today we got a little bit different of a show today. We're going to be talking with Brent Kawakami. Brent and I and a couple other partners recently finished a 136 unit deal in Atlanta. And we thought it might be a good idea and a little bit valuable for some to go through the story and talk a little bit about how this deal came to be, some of the factors that went into it, and why we chose to um, do a few things differently on this deal than we have in the past. So this is a fun show for me. And we recorded this video at like 4 or 5 in the morning this morning. So if we look a little tired or a little sluggish, you might understand why. But the value is there. So I really encourage you to watch the video and to give us some feedback. So with that, let's get started. All right. Welcome back, everyone. Hey, Brent, how are you?
Hey, Lucas, how's it going, man?
Good, good. So I wanted to have you on and let's talk about the 136 unit deal that we just closed, I guess a month ago, three, four
Yeah,
weeks ago. I
yeah,
wanted to have you on and talk about maybe some lessons learned or some, um, I guess some takeaways that we learned from the deal that might help other people moving forward. So I guess let's just jump in and talk about, maybe the story. Can you give us how you found the deal, what it looked like, and maybe some details that you think it would be relevant?
yeah. The deal that we closed was a 136 unit deal, property over in Atlanta. This property came up. This was an off market deal that got brought to us by a broker that we had a relationship with. It's who I bought a deal from last year, and then our group has done a few transactions with them. So we have a great relationship with them, and they're really good, really good firm, local to Atlanta. And it was a deal that actually got brought to us at the beginning of this year. And at first glance, we took a look at it. It was, I think it was 63K a door that they wanted. And, we took a look, kind of told them, hey, really mid to high 50Ks a door is what I think we'd come in at. They had another buyer that was willing to give them the full asking, so they ended up going with that buyer. No, so it's sort of a hey, no harm, no foul type of situation. And then maybe a couple months later, they came back. First buyer didn't come through for varying reasons, and we can get into that. But they came back to us, hey, are you still interested at, around the price you're looking at? And then, there was a little negotiation, and then we ended up locking it down for, price that we were really comfortable paying, and which was great because it was also comparatively to a lot of sales comps, a little lower than what a lot of other similar properties were selling for. So from that standpoint was, a great find for sure. And I think, maybe a couple of lessons learned there is one, obviously building relationships with brokers and staying in touch and that type of thing is very helpful in terms of deal flow, but then also getting deals coming back to you as well, right? The thing, is, multifamily investors are always looking at different properties. A lot of times it's not the first offer, the first best and final, the first buyer who ends up ultimately closing the deal, right? And so I think one thing that's important is that you put your number out there, you put your case forward, and then that's where, hey, maybe you're second in line, maybe you're third in line, or maybe you're the guy that first guy follows through, they come back, hey, maybe you're interested in. So I think that's where it's important to make sure you're putting offers out, make sure
Yeah.
people know where your number is coming at, and then you're staying in touch with that broker. So
Yeah, I
I
think
don't know.
what
You have any thoughts on that?
Yeah, I think what really helped your case was not the price, because the price is dictated by the property. There's very little anybody can do about that unless you're
Mm.
willing to overpay. Uh, but I think what ultimately got, excuse me, what got you guys the deal is um, being able to be flexible with the terms. And maybe you can talk a little bit about that, but they want to take it to a firm that they know can close and they know will be able to accommodate the seller, because that's super important, because the broker wants to get paid too. So they're going to bring it to whoever they thinks they can get it across the finish line. So maybe you could talk a little bit about the seller's needs in that situation.
Yeah, so that's important, right? Because obviously price is price, and if someone's willing to pay a lot, that's if you're selling a property, that's what you want. But
Yeah.
certainty of close is huge, right? Especially in this space, because not the single family versus multifamily, the number of people that can actually close a bigger deal like this is much smaller,
Hmm.
right? And so, and that goes to certainty close, but ease of transaction and actually, like you said, terms and getting there. So in this instance, as an example, and this goes to talking and building a relationship with broker and finding out the story and what the seller's needs are. In this instance, price wasn't necessarily the most important thing, at least after the first buyer fell out. And one of the reasons the first buyer fell out was, like you said, terms. There were some disagreements with the due diligence period, some disagreements on how long that should be. This particular seller, long story short, wanted things to be tight from a due diligence standpoint, because once a buyer got in and started walking units and under contract, they wanted it done. They didn't want any of these retrades. They didn't want any of these situations where, oh, I find out I'm getting in over my head,
Yeah.
things like that. So that was one of the things we were able to accommodate with, and we actually had a very, very short due diligence period comparatively to a lot of other traditional transactions. But we were able to do that because we had done a lot of homework on the property before. B, we already had teams on the ground in
Hmm.
Atlanta that we had properties there, so it allows us to move fast. And so that, and we had our financing ready to go, we had a PM ready to go, we had a tax consultant who already reviewed things. So it was one of those things where day one we were off the blocks. So I
Yeah.
think, like you said, that's probably a piece that are important for folks to take away is preparation and being prepared. Allows you to move fast and have certainty and portray that to a seller and a broker.
Yeah. Due diligence is expensive. I mean, flying people out there, getting everybody on site, doing all the inspections. So, one thing I learned from you is really trying to get as much stuff done before you get to the property as possible. So, whether it's having people drive by, doing secret shoppers, or having a contractor drive through the property, giving a best estimate, anything you can do that's free before you get to that point of due diligence. So that, like you said, when we were on site, after the first day, maybe the second day, we're going to walk away from that knowing whether we're going to close or not. And,
Yeah,
it's pretty
yeah,
easy to see giant holes in a roof or something that's really going to, hold us up. But some of the other stuff, maybe structural or pipes or everything, that might take a little more time. But at the end of the day, if the seller wants to sell in 5 days, you're going to do whatever you can to make that happen.
yeah. No, you're right, and it's there's a lot of stuff you can do, like you said up front. Contractor can drive by, look at the roofs from, you know,
Yeah.
you don't need to wait, you don't need to necessarily, wait till I'm on day 21 of the contract to
Yep.
do that, right? Or, hey, and that's what gets a lot of times, when you get into retrade situations too. And that's one thing that, again, that from an ease of transaction point, are you going in and retrading stuff that, hey, you should have, in my mind as a seller, you should have known well before we ever got under contract, right?
Yeah.
Like you said, hey, I can tell, I'm not a roofer, but I can tell we probably need some new roofs here, right?
Hmm.
As example, right? Or
Yeah.
hey, you should have known that parking lot needed to be repaired.
You can
That's
drive
pretty
through
obvious.
it. Yeah.
Yeah, exactly, right. Or if you didn't budget that you're gonna, do an exterior paint, or you needed a new playground or whatever, like those are things that, even before you come to the table, you've already accounted for. And
Yep.
so what's crazy is not every buyer necessarily does that. And then, like you said, due diligence is expensive, right? There was another property in Atlanta we were under contract in the beginning of this year, and crazy story. But so I'm on the flight. I don't know if I told you this. So I'm on the flight over. So I'm in Dallas. I'm on the flight over to Atlanta the day before, on Sunday, to because due diligence is starting next day. We had an early access agreement on that property, and the broker like is texting me because I have plane Wi-Fi, and he's like, "Hey, the seller's like, you're not planning on walk-in units tomorrow, are you?" And then I'm like, yeah, due diligence starts. That's in the contract. And so the second I land, like we get our attorney and other partners on the phone. Um, and long story short, like it ended up being just a cluster because we got on site the next day. We have, partners flew in for the property, right, to go walk the property. We had a PM there, and a team's ready to do unit walks. We had a roofer ready to, go look, a plumber ready to look at lines. And we're all just twiddling our thumbs standing there because like the seller the seller didn't authorize his staff for everything, and the brokers in the parking lot on the phone screaming at the seller and stuff like that. So there's a lot of time and effort that goes into this stuff, and things like
That's so
that.
funny.
Yeah, things like that. I mean, it is what it is.
Maybe we should have
But
done a lessons learned on that one
on that one.
instead of this one. This one, I mean, we were talking earlier, is like this one, knock on wood, has been a very smooth transaction and almost to the point of being boring, which is exactly what you want. But a lot of
Yeah,
preparation went into that too. I mean, it wasn't by
yeah.
accident. So
Yeah, and we
I,
can talk through that too, and like everything from due diligence, everything through, a big hiccup is the financing and getting through the lending that ends up causing a lot of hiccups. That
yeah,
went fairly smooth. But there's reasons for that too, right? I think
yeah.
there's
Well,
because
let's
the
talk about that.
property. Yeah, yeah,
I mean, from
yeah,
the gate, when you're underwriting this property, you knew what kind of financing product you wanted, right? Like
yeah.
when you first got sent the deal by the broker, you knew, you had an idea of what kind of financing you wanted. So take us from there.
Yeah, so like, and that's one of the things you want to do back to all this preparation that we talked about, right? So like from the financing arm, you're obviously as an investor, you're doing your own underwriting, right? And whatever you need to do to hit your metrics and your investor returns and things like that. But a real big thing is having a mortgage broker review the property and the financials up front, right?
Mm-hmm.
And doing an underwriting themselves, because the way that a lender is going to underwrite a property is completely different from the way an investor is going to underwrite the property. And that could be everything from, what they're accounting for in different expenses, what
Yeah.
their take on the income is, the story, et cetera, et cetera. And so as an example, in this case, we knew the kind of product we wanted. We had a mortgage broker underwrite it well before we were ever under contract. We had an actual lender picked out, and so we had a term sheet, which for those no investor left behind. It's term sheets. Basically, it's the actual lender who's going to do the loan. They've reviewed the property and they've actually done an underwriting on it. So an analyst there has taken the financials, taken the rent roll. They've reviewed it, based on what they think. Here's how much the loan values, LTV is going to be. Here's the interest only if you're trying to get that. Here, what
Yeah.
is your rehab plan? These are the rehab funds we're going to include. All of that set up front, right? And then we had discussions with with the actual lender who we picked out, and we shopped it too, right? We
Mm-hmm.
talked to through our broker, 3 different lenders, and this particular property we did a Fannie Mae agency loan, which is the Cadillac of
Yeah.
multifamily loans that you want, right? But we shopped it. Came on a particular lender, but all that was lined up. And so, you different contracts, once you start off, there's different, periods of, when you're getting your loan application in, when certain things are supposed to happen. But that was ready to go. And, day one, it was like, okay, as long as we don't find anything crazy, we're in due
Yeah.
diligence, we know we're moving. Right.
Yeah.
And we've already lined that all up. So, I think
Yeah.
that goes to like the big thing with the lender.
And that's not to say, I mean, things change drastically from your first underwriting to your last, but what made it, I guess, attractive from an investor standpoint is you went in with a set idea of what it was going to cost you to rehab this, and it was around $5,000 a unit. Um, Things changed on our due diligence. Like you had budgeted for new, like, pool furniture. We found that in storage. So then you shifted that money to stuff we found. And so it was just a give and take, and it changed all day to day. But at the end of the day, it didn't blow the budget out of the water, and you were able to, pivot and make those changes. So the underwriting stayed relatively similar.
Yeah, and then you have buffer too, right? Because that's the
Hmm.
other thing. Maybe that gets to like the lending and the underwriting when you do it front. Because inevitably, and that's what scares me when I see a lot of deals the way they're underwritten. There's not as much margin or fluff or something to go, to change, right? And that could be
Hmm.
everything from your rehab budget, like you mentioned, but that could be everything from the rate you're getting, right?
Yeah.
An example. So in Fannie Mae's case, you can rate lock early, but in most instances you're not rate locking until closer to your closing date. So if there's fluctuation and rates go up, well, that affects your turns and your
Big
underwriting,
time.
right? um, your loan proceeds can change over time just based off of, as the lender gets more into the underwriting, you're actually under contract, right? And hey, what you don't want is you know, hey, I get to day 30 or 45 or whatever in contract, and it's like, hey, we need to cut your proceeds by, 250K, which can happen, right? And I'm
Yeah.
sure it happens a lot, and that's why deals get in trouble. So
Yeah.
I think, maybe another lesson there is, we had good margin here. The deal underwrote incredibly well. And a lot of that had to do with, we stuck to our guns and got a price we were comfortable with for sure from the beginning. Right. But we had room for fluctuation if we need to. And then the great part too, in this instance, is a lot of that fluctuation actually ended up in our favor.
Yeah.
Example, we allotted more for replacement reserves and we ultimately didn't need that much. We underwrote for a little higher insurance quote, came back a little lower than that. Great thing. So the rate we underwrote at, and this was pure luck, right? I mean,
Yeah.
we had, I think we gave maybe half a point higher on the underwriting of what current rates were at the time versus what we ultimately ended up getting. But we ended up locking something below 4%. And
Which
when
is
we
crazy.
underwrote it, yeah, which is crazy, which we underwrote, something closer to 4.5, so and again, that was pure luck. But, but those are the things that, that margin and fluctuation within your underwriting, I think allows you to create that smooth transaction, right? Because, first thing you don't want is lender cuts your proceeds. Oh, crud. Now I got to raise more money.
Yeah.
And, or explain, oh, my underwriting doesn't look as good. Now I got to go back to, whatever. Right. And so,
Yeah.
that,
Yeah.
that helps with the smoothness of the transaction.
Yeah. And a lot of what you're talking about is lessons learned from past mistakes. So maybe talk a little bit about the experience on the team and how that played into it too.
Yeah. So, because our team, has done deals before. So I think there's, like you said, there's a lot of experience there. I think one thing that's relevant is, so, we did a Fannie Mae loan on this property, and, the team has a lot of experience doing that. And so as a result, you can kind of anticipate some of the things that the lender is going to come back with later. Right.
Yeah.
So as you go through the process, right, and you have your team lined up and your KPs and whatnot. Hey, there's certain docs that people we're gonna have to provide, right? Or hey, they could ask for this particular item, or hey, I know that something on this looks a little different. They may ask about that. So I think anticipating what they were going to ask for, anticipating questions, and having everything ready up front allowed us to be very flexible and quick. And so inevitably through a transaction, a lender is going to come back, as they're, working on the loan, they're going to come back with questions. They're going to come back with requests, and we're turning that around in less than a day. In fact,
Hmm.
within several hours. It blows my mind because I've had, lenders say that, they're waiting on other groups for similar types of products for a week, for, you know,
That's
for
crazy.
something that's like, and stuff happens through deal, right? Hey, the attorney forgot this page of something, right? Or,
Hmm.
hey, we need all the KPs to docu-sign this addendum, because we left this out or whatever, right? And, it's really great when, our team, because of the experience, and that happened, that actually happens on deals and happens to us on multiple occasions. But it's like, hey, we turned around signatures on something, within a day, right? As an
Yeah.
example. And so I think that goes back to the experience. And then, as crazy it sounds, being preemptive about things that I don't think everyone, unless you have the
Yeah.
experience, you probably don't know.
Well, you think about that over typical 45 days to close for the lender, right? If you think like, oh, this is taking me an extra day to get this to you, over the span of like 12 items, that's adds up to 12 days. That could drastically change your rates. Like 12 days from now, we don't know where rates are going to be. That could cost you a lot of money, like you were saying earlier. So making sure you're on top of that and making sure you have all that stuff ready to go, even if they don't need it, it's still a
Yeah.
good exercise to have,
Yeah,
especially for
exactly right.
future deals. They might ask for it
Yeah.
in future deals. So
Yeah,
yeah, that's
exactly.
interesting.
You know,
What are
exactly.
what are some of the questions that came up when everyone was raising money that maybe might be good to highlight?
Good to highlight. Yeah, because you always get questions here and there, maybe you've never approached or,
Yeah,
different things.
I I had an interesting one,
Mhm.
which which was a little frustrating, but it was also a good exercise for me. And he, the gentleman that was questioning investing, he wanted to know about refinancing in the
Yeah, I
period,
remember
and
him. Yeah.
and and it's hard to explain this to someone who might not know, but maybe you can explain why refinancing with a Fannie Mae loan might not make the most sense.
Yeah. So like, and one of the reasons we like those loans is so this was a long-term 12-year, 12-year term, 30-year AM, with a fixed rate, which is, that's the best you want, especially
Hmm.
in these types of deals, right? And you have prepayment penalties on these too, right? And
Yeah.
so one of the great things about those types of loans is they have the option of a supplemental loan, which is, I mean, a simple way to describe it is like, I don't know, a HELOC or a second, a
Yeah.
second note, and so what's great about that is say, and this, depends on your business plan, but the flexibility of, hey, maybe I hit my year 5 projections in year 2. Instead of us just going to sell them the property, I can do a supplemental loan, which is through the same lender, relever the property, pull cash out, return it to all the investors, and we still own the property and we still cash flow, which
Hmm.
in my mind is awesome, right? That's what you want. Hopefully, we can return a lot, right? I've seen
Yeah.
deals that have returned 50%, 80% of, cash back
Yeah.
back to investors, which is great. But for someone who's maybe not necessarily familiar with that type of product or that strategy, maybe that sounds foreign, right? And then of course I think the issue you ran into was that that particular investor was used to deals being structured a little differently in that
Yeah.
regard. And yeah.
Or not used to it, but the deal he had done before was structured in that the general partners don't share in any refinancing
Hmm.
proceeds, which,
Yeah.
going down that road just a little bit, if you don't share in those proceeds, you are possibly incentivizing your general partnership team to sell before it might be advantageous. And
Yeah.
Mark, you know, we want to incentivize ourselves to hold it when it's to its maturity, basically, till it
Yeah.
doesn't make sense to hold it. And if we're sitting there waiting for a payday, we might be skewed one way or another. So sharing in refinance proceeds is an easy way to pay us for the work we've done, return member capital. But that whole conversation was, I don't want to say pointless, but it wasn't even on our radar
Hmm.
because of the supplemental loan.
Yeah. And I think that goes maybe the higher level lesson learned too is like, it's alignment of interests and expectation of, your
Yeah.
investor and your,
Yeah. And
your,
I just didn't do a good job explaining it. That was on me. So,
yeah.
I mean, that,
Yeah. But part of that's, that discussion, it's never come up. Right. And then part of it too is, hey, that particular investor's maybe not used to that,
mhm.
used to that type of structure. It's just, you have to have the conversation, with them. And, that's important too, because I think a lot of people or a lot of investors get hung up on, well, how much are the general partners making, right? Or,
Yeah.
hey, when there's this event, hey, why are you making funds, right? And I get it, I understand that, but on the flip side, we don't work for free too,
Right.
right?
Yeah.
We're trying to make money, and I think what scares me sometimes because I see other deals where, the the general partners making so little funds, right? They're slicing the, any kind of fee, slicing any kind of equity split so tight that, they're not making any money. And, it's
Yeah.
not an alignment of interests in my mind, right? Like,
Right.
if times get tough or challenges, come out and you're not making any money anyway, and not to say we would, right? We would want to do the right thing, but is everyone going to do that, right? If you're
Yeah.
making $0 and working for free, and then stuff happens,
Yeah.
who knows?
Where in year 4, where is your incentive to keep going if you're not making any money on that deal? I mean,
Yeah,
it now you and I would have ethical issues with that. I mean, we would
yeah,
still work our butts off, but the problem becomes like it's a misalignment of issues, like you were saying. You want
yeah,
everybody on the team to be making money so that everyone has a good experience, so that it continues into a new relationship. And
yeah.
yeah,
Yeah,
so
exactly. And you see that too. Like I've seen, and maybe not necessarily in this instance saying a refi or supplemental, but even with sponsors who sell deals really early, right? Like how many times you do, I think our team's kind of more of the hey, buy and hold,
mhm.
you're leaving money on the table if you try to sell earlier. But you see a lot of deals where it's like they're almost incentivized to, if hey, I can hit a decent amount in year 2, let's sell. You know,
See, and
and everyone
that's
makes money. Everyone makes money, but I think again it goes to a disalignment of interest, right?
and the
So
reason they're selling is because syndicators make a lot of money on, you know, disposition
yeah.
events.
Yeah,
Um,
and then they can go, hey, I hit these numbers in 1 year, right? Which is, past performance doesn't indicate future success, but
yes,
on the flip side, it's not sexy for, hey, we bought a property and held it for 7 years, right, and made a killing. No,
right.
it's the hey, we sold in a year and blah blah blah. So
Which, by the way, is all appreciation. It's not it, very. I shouldn't say that. Very little, I would guess, is probably due to operator efficiencies. But at the end of the day, investors, we're selling to them a passive investment that they don't have to work on for 5 to 7 years. We don't want to burden them with a capital event in year 2 if it doesn't even make sense, all because we
yeah.
want to get paid.
And that's the key, right? If it makes sense, then great, right?
Mm-hmm.
And I think that's where I like the business model of having flexibility, right? Hey, we could sell early if we wanted to. We can hold it, economy goes to crud in 2 years. We can hold it longer than we thought. Or,
Yeah.
hey, let's just do a supplemental, pull all our cash out and still hold the property. So,
Yeah.
having that flexibility allows you to do what the appropriate thing is at that time that is in
Yeah.
alignment with everyone's interests. So,
Yeah. In part, going back to that investor question, he wasn't upset about it. He just wanted some explanation. And it just turns out that his thinking about it just took a little too long. I think he probably would have invested if the deal hadn't oversubscribed so quickly. So, I
yeah.
mean, talk about what led to that, because that was, I mean,
Yeah,
it was less than 2 weeks before
yeah,
we were
and
cut off.
that's that was a thing that I'm still trying to grasp my head around what the lesson learned on that was. I mean, the reality is that's a good problem to have, right?
Really good
It's
problem to have.
Yeah, right. I'd rather have that than the other problem. You know,
Yeah.
uh, as someone, you probably like me, right? You get deals from other syndicators that get sent to you, and you're like, why have I seen this deal like emails for the last 2 months? Or,
Yeah.
you know, I've seen it from, 6, 7 different people,
Yep.
and you're kind of like, oh, are they having trouble
Yeah.
potentially?
That's my first
So,
thinking.
yeah. And, whether that's true or not, who knows? But, perceptionally, that's the thinking I have too. Um, but in this instance, like you said, we were able to put together and raise funds incredibly quickly. And I think that goes to a lot of things, right? We had a good team lined up. We had investors kind of primed and ready to go. I think
Hmm.
the deal was a good deal, right? It's the deal spoke for itself and things like that. So but it's still a problem in a sense, because we had to turn people away, which
Right.
is not the best thing in the world. We had to tap the brakes, right? And I think,
Yeah.
maybe that goes to having, we probably didn't have a good way, we track it, but there's probably some efficiencies that we could have had in terms of, lining people up a little better and taking more true soft commitments up front. It was kind of, for us, it was sort of a, hey, close the floodgates,
Yeah.
you know. But yeah, I think I'm still trying to get my head around what the lesson learned there on that is. But again, I think that's the good problem you want.
Yeah, I mean, like you said, it was a good deal. The track record of the team really played into that for me anyway.
Mhm.
That was something that was made it such an easy sell, and it was a good market. I mean, it was in the
Yeah,
Atlanta market, which is a lot of people want to be there right now, and a lot of people are overpaying to be there right now. Whereas
yeah,
this is getting almost 10 grand a door less than market price, which is, I mean, I think that's probably what led to most of the success.
yeah, yeah. No, so I think you take that and you learn on the next one. I think the great thing, though, in that instance that comes out of that is now you have investors that are a little more primed, right? So
Hmm.
like even the gentleman you mentioned before, okay, now the next time you go to him, right, it's like, okay, hopefully you don't have to have that same discussion
Yeah.
that you did, right? But then B, he knows, hey, I missed out on this,
Hmm.
on the last deal, it went that quickly. And again, every deal is different. It's not the same. But, maybe you have investors that are a little more warm, right? So that, they move a little quicker
Yeah.
on the next one.
Yeah.
So that's, that's a good byproduct of it.
Yeah. So if you had to take maybe one or two things away from this deal that you want to implement into the next deal, what would they be?
Ah, gosh, I would do a lot of these things the same way, right? And all the
Yeah.
prep and things like that, that we did. Um, I think, as I think back to it, we were drumming the lender really hard throughout the whole process to get things going. And long story short, we ended up having to wait on the lender
Yeah.
in the end, and they were the delay of why we could have closed early. In fact,
Hmm.
really early. But a lot of it was, a lot of it was just, hey, where's this? Where we're waiting on them. And I think one thing that we found is, unfortunately, the reality is, a lot of people touch a file that, that's just their day job, right?
Yeah.
And so there's not the sense of urgency. There's not the, personal, commitment into, hey, things going through. So,
Yeah.
could we have done a better job? I feel like we were kind of foot on the gas, but I think being kind of cognizant of that, and, not being afraid to, you know, I hate bugging people, every day, right? But, that's something that I think, you just kind of taking a step back and it's like, hey, this took an
Yeah.
extra day because, so and so's it's file 5 out of 10, and
Yeah.
I don't know that there's something I take away necessarily, but I
Well,
think
it
that was a
actually,
realization I had.
yeah, and it actually worked in our favor too, because we were ready to rate lock back when things were at like 4.25,
Mhm.
and they just kept pushing the ball down the court and couldn't do it and couldn't do it, and rates dropped another 25 or a
Yeah,
quarter percent, which was really advantageous to us. But yeah, so
yeah.
I mean, I don't know, other than trying to replicate it,
Mhm.
finding another deal like that, and but no deal is going to be the same. I mean,
Yeah, every deal is different, right? And every deal is going to have its own bumps and bruises.
hmm
Every deal is going to have certain things you don't like about it.
yeah,
But it's just, you just roll with it. And yeah, I
yeah,
think the biggest thing for us would be to try and replicate exactly what we
yeah.
did.
I think one of the biggest takeaways I took from it is focusing on the things that we can control.
Mhm.
And because you're not going to be able to control whether the property has structural damage or broken pipes or whatever, but you can control the level of due diligence that you do, the level of preparation that you put into things. You know, there's no such thing as too much due diligence when it comes to, you know, taking investor funds. So as much as you can do for free before you're under a hard money deadline, because after that 5-day due diligence, your earnest money deposit went hard, meaning you can't get it back. So you
Yeah.
want to get as much stuff done before then as possible. And that was just a new thing for me.
Yeah, no, it's big, and again, that goes to having the team to do it too, right? Like, not only the on the ground team, right? We
Yeah,
had we had a PM who manages two properties that are direct comps,
that
so
that was
or
awesome.
which was
And
great, right? Or they secret shopped it, that we had full budgets, things like that. And even the sponsor team too, right? I mean, you were a part of that, right? Not only were you there walking units, but you called the local, you called the local police department, you
yeah,
called the local economic development. I think didn't you call and inquiry over the phone
yeah,
as well? So
yeah.
it's
But all those things were free and we weren't under any
yeah,
sort of deadlines. And who
yeah,
knows, if something would have come up, that would have been like, whoa, that's a big red flag.
yeah.
Now, nothing did. In fact, it was almost the opposite. Like every single thing I did only further compounded why we should be investing there, which was
Yeah,
cool.
exactly.
And then we
Exactly.
found out, what was it, like a couple days before closing, or maybe the day before closing, that
Oh
a
yeah.
major grocery chain was dropping like a ton of
Yeah.
jobs right next door. So
Yeah, it was like 10 minutes just east. So again, and that's luck, right? I mean, we
yeah,
couldn't
pure
have
luck.
pure luck, but I think that goes to, you line up all these things, and that goes to, not only all your due diligence, but like the story and the sub market and the property itself and everything. And so
Yeah.
y- your hope is, because of that, you have all these things going for you that, ultimately outweigh any, sins
Yeah.
that end up happening. Knock on wood,
Right.
so
Right. Yeah.
yeah.
Cool.
But,
Well, I mean, this has been really helpful, and hopefully it's helpful to other people. But if people want to reach out to you, where can they find you?
yep. So my email is Brent at thinkmultifamily.com. You can reach out to me there.
Cool. All right. Well, thanks, Brent. I appreciate your time.
All right. Good talking to you, man.